Good afternoon. This is Coach Mike from WinningStockCoach.com. Going to begin in this video speaking in regards to our market overview for the week ahead beginning February 24th, 2014. I want to point out a couple things about the chart that you're seeing. This is a weekly 5-year chart of the DJI, which is the Dow Jones Industrial, and it is showing you a channel that has progressed since the markets bottomed in March of 2009, and the trading since. Now you see this other trend line that I've placed in here that's within the overall channel, and there's a ironic anomaly for it. Now I've been talking about this the past few weeks in the market overview videos I've put out, and until now, really, those videos have been a progressive prediction based on factual representation. And even though they were a prediction at the time, seeing them come to fruition here, seeing the results of the prediction actually happening as I anticipated, has allowed me to, plan appropriately, have desired strategies to prevent losses, and to still have confidence in my trading throughout this time. Now, everybody's heard of QE, that's quantitative easing, and you've heard me speak of what I call the fundamental change happening in the markets, and that's the easing of quantitative easing, which would be commonly referred to as the taper, as they're reducing the QE. Now, QE is basically a stimulus run by central banks, in our case, the U.S. Federal Reserve, and it's basically them pumping extra money to sustain the economy, and now that they are tapering from that, it is based on their assumption that our economy has, recovered or is in recovery process to where they can ease that stimulus and let the economy stand on its own. Now, there's been different phases of QE introduced into the market, and the one that's most commonly studied is QE3, which is nicknamed QE Infinity. This was announced in September of 2012, and we can see that the market actually did not like the announcement of further QE as we got a dip, and as we bounced off that trend line that we had already set, we see in December a higher low formed in the formation of a new trend line, which is where I get this trend line from. Now, the importance of that is to understand what happened in December of 2012 in relation to QE3. QE3 had an initial amount attached to it. And how it got the nickname QE Infinity was how it was just randomly raised in December of 2012 on how much spending the Federal Reserve would do to stimulate the economy. And ironically, it was the time through this period where this new trend line was set. Now, all throughout 2013, we traded well off of this trend line. You see that several bottoms were bounces off of this trend line. And then we get into December, where it was announced that they would begin a reduction of that. Now, I've told members of the coaches roster several times that as the fundamental change takes place, that we would begin to see lower lows and lower highs at just a very, very simple technical analysis to make. A series of lower lows and lower highs over the process of the markets correcting to a level prior to the induction of QE3, as that QE3 is reduced, over the course of 2014 as their current plan states, down to zero. Now, in my opinion, that's going to lead us down to at least the channel that's been set since the markets bottomed in March of 2009. Now, another funny thing, and this is aside from the fundamental change and anything else, just simple technical applications that you can apply to your charts as you're working your charts, as I call it, working your charts to stay active with your trading and whatnot, and to continue evolving your trade plans for positions you're in or positions you're looking to be in. You'll notice that even though the market reacted against what many people thought it would when the actual taper was first announced on December 18th and we shot up to a new high, we see that at this point in time that high was kind of right in line with what I had analyzed to the members of the coaches roster as what I saw it as. It was it looked at the time like, because it made little sense to rally like the markets did, it looked like it was one of those last hurrahs, as I said. Let's get one more high, and then we'll prepare for some negativity. In January of 2014, we saw the New Year open with a pretty extreme pullback, and we've seen a nice bounce up from that. Now, as you apply technical applications, and I'm going to be talking in relation to the most simple of all technical applications, which is trend lines. Pretty much any charting service that you use will have trend lines, and you can use trend lines to connect bottoms or tops on your charts, and it establishes for you an easy way of telling when you may want to enter a trade off the bottom trend line, to go short on a trade from the top trend line, and even get out of a trade that you're long in should it fail that bottom trend line. Very, very simple technical tool to apply to a chart. Now, what you'll find in the study of trend lines and channel trading is that when you come to a time that you fail a channel line or a trend line, more times than not, on the failure of what we would call support, which is the trend line, you will come up and retest that same trend line, now serving as resistance, and pull back from it. As you see on the chart in front of you, it seems that is exactly what we've done. Now, aside from trend lines and such, there's a very, very common, even easier technical way to analyze a chart, and that's by measuring the position of the lows and highs. People would call this, or ask if their chart is making higher lows and higher highs, or lower lows and lower highs. And that's generally a good way to get a reading on the bullishness or bearishness of the chart that you're looking at. Throughout the validation points of this trend line, we continued to make higher lows, and there were a couple points, like here, where we made lower highs, but our lows continued to be higher. And as it seems here, we made our first lower low. Now, if you're analyzing a chart technically just by using the position of the lows and highs, when you see a lower low, though it's not guaranteed to be this way, you must trade with an anticipation that a lower high will be made. Now, with even that set aside, because as you can see, the week before last, we closed higher than we did this past week, indicating the retest of the trend line to serve as resistance and a pullback from. We also are left with a particular pattern being made on the chart, which is commonly referred to as the most bearish chart pattern. That'd be called a head and shoulders. Why is it called a head and shoulders? Well, I want you to look at this area here that I'm circling. This area here, and I'm going to remove the circle to make it a little easier to see. And what you're going to see is the resemblance of a left shoulder, a head, and a right shoulder, where the price is in relation on the high to the price at the left shoulder. Where does this particular pattern become verified, become bearish? It's not on the pullback from what could become the right shoulder. It is on the failure of what is known as the neckline. It would be, should a lower low than the low made here be seen, that would indicate a confirmation of a head and shoulders pattern. When you put all of these things together with the fundamental change of the reduction in quantitative easing and the affiliation with this trend in regards to the third level of quantitative easing, QE3, and the failure of it coming after the reduction or the tapering from the amount of QE3, all of the sudden you begin to have a perspective of this chart that makes a lot of sense. Now, my concerns are that we will continue a pullback from a resistance point in the upcoming week. Does that have to happen? Is it guaranteed to happen? Absolutely not. Does it have a higher sense of probability that it will happen? Yes, it does. The important measure for anybody here is not whether or not it pulls back. It's whether or not it pulls back and creates a low greater than the low that it's bounced up from. And on that subsequent confirmation, should it confirm a lower low, we would have many senses based on the technical aspect of charting to believe that we will at least head to our next level of support. Now, that's nothing to be afraid of. There's ways to protect yourself through leveraged positions. Maybe you have positions that you're up considerably in. It might be time to just reduce a little. If you see the confirmation of the pullback, you might want to stay in the position, but take a little off the top. Would be my recommendation. I know I only make recommendations based on my own buys and my own sells. So my plan for the coming week is to be looking for that on Monday so that I can make the proper decision on whether or not to reduce position sizes, whether or not to leverage common share positions via put options, which give me a right to sell at a specific strike price, or whether to not worry at all based on what I see in the upcoming week. So, don't take this as the media type scare tactics to let's scare you out of everything just so we can run it up after you sell. This is, quite literally is something I provide to my subscribers with the coaches roster, and I put out to members of the Practice Squad, which is a free email list that I provide educational material on stock and options trading to. And I want to make sure purely that people are informed on possibilities and probabilities. And an understanding of the indices gives you a direct understanding of how your stock may be affected. Because the reality of many things is it doesn't always quite matter how good or how bad your stock might be. When the markets are heading in a specific direction, whether that be up or down, you will find greater than 80 to 85% of the stocks being traded will actually correspond in direction with the indices. So now we're going to switch over to the RUT. This is the Russell 2000, commonly known as the small cap index. And again, we see the longer term channel from the time the markets bottomed in March of 2009. And we see this line being started the same time it was on the Dow Jones Industrial Average, and in relation to QE3 and the raising of the stimulus of that monetary policy. We see several bottoms in correlation with this line throughout 2013. We see as this long-term channel was hit at the top, a pullback that failed that trend line, and a rise that has only retested that trend line as a resistance point as of right now. Friday was a bit of a gap up day if you look at a daily chart for the Russell 2000, and it closed red in relation to its open, but up in relation to the prior day, and ultimately closed up for the week. If it begins pulling back in the upcoming week, we would look at that as a pullback from resistance, and then again possibly a lower high. Let's look at the other times the top of this channel line, the top channel, was hit. At the time the top channel was hit here, we began making lower highs, lower lows. When our top channel was hit here, we made a dip that ironically is very, very similar looking to our current pattern right here. And if you remember from previous market overview videos that I've put out, a few weeks ago we did a look at the 20-year on the indices. And I showed you the correlation between the tech bubble, the rise from the mid to late 90s up until the tech bubble that took 5 years. I showed you the rise after the tech bubble bottomed and the housing bubble began to be 5 years. And I showed you in correlation how the market bottomed in March of 2009, and 5 years from that is just a week or two away. So it is interesting to see lower highs being made almost as a warning sign to what in the past has been a replicating pattern since 1995 of a 5-year excessive uptrend followed by what many called a market crash, even though it still returned to values higher than what the rally had started before the tech bubble, and the market crash for the housing bubble that still resulted in higher prices than where they started before the housing bubble began. And here we are experiencing fundamental change in our markets and seeing what to me has commonly proven to be a bit of a warning sign in my trading, as I see a lower high created, as I see a trend broken and retested to serve as resistance. Generally, the warning sign for an exit. And like I said, this past week we did not close down from the prior week in the Russell 2000. So we would need a confirmation of this before we went and panicked and sold. But I like to think of these charts as a storybook, and I'm not a writer. I don't write storybooks, but I read them. And if you take the time to read them for what they actually tell you and not what you want them to tell you, you generally find better results out of your investment experience. a failure to do that results, for many, in not understanding why stocks that they like go down after they buy them. Now, the most important one to me personally is the chart, the SPX, which is the S&P 500. We do see similarities in the overall trend that's been made since the market's bottomed in March of 2009. We see the tops that hit in the channel, same time periods as the Dow Jones Industrial Average and the Russell 2000. We see this minor, the shorter term channel, beginning at the same time in relation to the induction of QE3 and the changing of that monetary policy in December 2012. The one thing we haven't got in relation to the S&P 500 just yet is a failure of this channel line. We did come down recently and retest it. We've bounced up from it. And we've really ended very, very close to the prior high. What this tells us is further pullback from this point would be confirmation of a lower high if it's unable to create a new high from the level that has already been made. And on that failure, I would expect at that point for this same trend line to be failed, just as it was with the Dow Jones Industrial Average and the Russell 2000. Does that mean that's what will happen? Well, it'd be hard to say that at this point, because every other time we've bounced off this trend line, we held it and continued upwards. So it's purely something that you need to be aware of as your support point. But until that point is failed, again, no immediate danger, even though for it to fail, that means it would have to go down a little bit. But just like I told you a few weeks ago, that until the line failed, you may be selling at the low when you may actually get a better opportunity to sell later. I'm telling you now that until this line has failed, which would be a higher point than the bottom before, we would be okay to hold longer term investments. Shorter term or recently entered things we may want to reduce or leverage via put options. Or we may be comfortable with this value here before we take any action. But understand, on the failure of this, we would again look for a replication of the pattern seen in the Dow Jones Industrial, where it fails and comes back up to retest it, thus creating a series of lower lows and lower highs, and would then begin an expectation for a return to one of two support points. Now, when you look at charts in this way, it gives you an easy way to obtain proper risk to reward analysis for your trading. Proper risk to reward analysis is what will make you successful or break you as an investor overall. If you understand the risks and you're willing to make that risk to obtain the potential reward, there is no shame in losing money on a trade so long as you exited the trade within your acceptable risk level, because it was accepted at the time of entry. But as you see things that start to present yourselves or themselves in the indices overall that are in direct correlation with global economic news, with fundamental changes in the marketplace overall, you are left to analyze or weigh again that risk to reward ratio in your trades and make proper decisions. Now, do I ever think somebody should be panicking and let's sell it all? I'm not that type of person. I'm not that type of person with my members. I'm not that type of a person to anybody else that I work at educating when it comes to investments. I'm the type of person that wants you to understand where not panic needs to come, but where a decision needs to be made. And until you get the proper verification, you only need to prepare that decision for either direction something may go, so that you can in turn make the proper move when the time comes. It is much better to exit a trade as a support level has failed and rebuy those shares off another support level retest than it is to hold hoping that it'll come back. And if you understand how to use the technicals to severely limit your risk in trading overall, while still allowing you potential for large gains, you will find a way to be quite successful as an investor. This is Coach Mike from WinningStockCoach.com, encouraging you all to check out our new website, which we launched this weekend, and to sign up for my free newsletter, The Practice Squad, as I regularly send out educational material for those members. Check out the Coaches Roster, which is a paid subscription offered by monthly and quarterly subscriptions, so you can have access to my library of training, video training and education, my premium chat room where I am on the microphone and speaking of trades and trade plans and charts all day, every day during market hours. You can join me for my evening webinars, and teamed with my other moderators, literally have a way to plan for your investment strategies tailored to you as a person and your capital to assist you in obtaining your financial freedom.